Hello, you lovely people. Welcome back to accountinglecture.com. Well, master budget is a combination of all your small budgets, like you might have sales budget, purchase budget, could be cash budget, trade receivables budget, trade payables budget. All budgets, small budgets, could be production, labor, or material budgets. When you add up together and make an income statement or balance sheet, now it is known as a statement of financial position, then that is your master budget. In this particular video tutorial, we'll go over an income statement question. Look at the question. It said prepare the forecast income statement. It is forecast because this is budget for the particular company, 31st March 2004. Okay, and we have been given with information from 2003. Based on this information, you have given 4 adjustments, 1 2 3 4. These adjustments we got to deal with and need to make an income statement for 2004. This is also known as incremental budgeting. Incremental budgeting. Why? Because based on previous year's information and with some assumptions for the next year, by increasing or decreasing some percentage, you are going to make another budget. That's why this is known as an incremental budgeting. Okay, folks, then let's begin the question by clearing our board. You can hear the noise of board clearance. Zig, 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 zig. Yeah, can you? Yes. All right. Let's start. You have given information: revenue 250,000 and 4 million, opening inventory 16,000 and some money, purchases, closing inventory, cost of sales, you deduct, you get gross profit, then overhead you deduct, you get a profit for the year. Okay, 4 additional information. So 4 workings. Working number 1, the unit selling price will decrease by 15%. Let's work it out. 4 million divided by 250,000. You got to do small working. You get, my calculator says it's 16 pound, but that will go down by 15%. So selling price 16, but of that, if you do 15%, you're gonna get 2.4. And if you deduct this 2.4 from 16, your selling price, the revised selling price, is a little lower now, which is 13.6. That is your selling price. Easy peasy, quick working. This is expected to increase the number of sales by 25%. Yeah, if you decrease your selling price, the demand gonna go up. Demand or units, selling units, 250,000 already, but if you make it up by 25%, which is 62,500, it's gonna go up by, so you add these two, the new selling units gonna be 312,500. Yeah, our first working is done. We will move to the second working, which says supplier will give you discount 10% on the last year's price. So what is the last year's price? Very often students tend to do mistake 10% on this figure. Not actually. You need to get the selling the price per unit. This divided by 254,000, which is basically £10, doesn't it? Yeah. Purchase. That was yours. Purchase. Working number 2 we are doing now. So purchase per price or cost per unit, you have worked out, which is £10, doesn't it? Of that you get 10% discount, which is 1. So if it goes down by 1, your purchase per unit is 9. Yes, price per unit. Yeah, the second one is done. The third one, very interesting one, says the ratio. Look at this. It's this ratio, the units of closing inventory to sales. Closing inventory to sales units will be the same in both years. Closing inventory valued at cost. We know it is cost. So what do you mean by that? they're talking about this closing inventory 20,000 and the sales is 250,000. Whatever is the ratio, we will maintain the same ratio next year. Look at the ratio first. If you do, so let me do working number 3 here. Just remember our figures. Working number 3, closing inventory, clo-inv. Okay, so the ratio they said, wasn't it 20,000, wasn't it? Yeah, just double checking. Yeah, it was 20,000 units and 250,000 was the selling units. We are going to work out the ratio or the percentage. Yeah, so 20,000 over 250,000. If you do the ratio or percentage, I run through percentage, which is 8%. Is going to be the closing inventory of your what? Sales. Look at this, read it again. The ratio of units of closing inventory to sales here will be the same in both years. So what is your sales? Your sales figures are 312,500. Yeah, of that you got to do 8%. Let's work it out. 312,500 is our current year's sales, which worked out, working number 1, times by 8%. If you do, I believe my calculator says it is 25,000. Just double checking. 312,500 times by 8%. Yes, it is 25,000 is your units of closing inventory. Fantastic. Yep, well done. So far, so good. So our number 3 is done. Number 4, the easy peasy stuff, says overheads are expected to increase by 6.25%. So whatever is that times by 6.25%. But yet again, I'll be doing working number 4, W, number 4, overheads. Okay, so overheads are 108,000 times by 6.25%. Okay, so what you get is here 67500, don't you? Just double checking. 108,000 times by 6.25. Yeah, and when you add up these two, should be added because it's gone up by 114,500. Lovely. We have done all our workings for 2004. We had information from 2003, and based on this information we worked out 1, 2, 3 and 4, and our workings are on your right hand side and at the bottom. Okay, I'll clean the board and do the income statement right now. Okay, the board is not just cleared, I made the performer for the income statement. Okay, if you remember the sales, we did working number 1 and we found 312,500 items of units at 13.6. If you multiply, the sales is 425,000. That's your sales. Now, opening inventory. What is going to be opening in inventory? Is it this figure? Answer is no, not at all. The closing of last year, that was 2003, is going to be opening this year. So it's just a copy paste items. 20,000 units at whatever is the figure, 200,000. Purchases, we have worked out. Working number 2. Okay, now for the purchases, we just worked out the figure £9, but per unit. But how many units? You need to do a small purchase budget. So which is basically not just working number 2. I'd rather put another W5. We have to do another budget. Let me do it for you over here. Purchase budget. Purchase budget. If you remember the formula of purchase budget, which is basically sales, whatever number of units you're going to sales, you need to purchase it, plus closing inventory. If you want to keep any items in your closing inventory, you need to purchase it, less opening inventory. If you have any items already in your opening inventory, you don't need to purchase, rather you need to deduct it to get your purchase. Okay, now let's put our figures in it. So sales is 312,500, and yeah, 312,500, and in your closing inventory we worked out our workings number 3. Yeah, 3. That closing inventory is 25,000. These are all units, bear in mind. And in the opening inventory is 20,000. Let's take the calculator, what it says. The purchase is 317,500. That's the units. You need to take it over here. Yes, 9 times by 317,500. So what you get is, if you multiply with 9, is 285,750. Opening inventory plus purchases and less closing inventory. So the closing inventory is 25,000, if you remember from our previous working, times by what? Cost, yeah, 9. If you multiply with 9 times by 25,000, your closing inventory is 225,000. Opening plus purchase less closing, you're supposed to get your cost of sales, which is 283,500. Take away from this sales figure, you get your gross profit, which is 141,750. Yep, that's your gross profit. And you had your overheads, we worked it out. Number 4, 141,750 is a gross profit. Of that, if you remember, your overheads are 114,750. You take away, get a profit for the year, which is here 27,000. That's your profit, folks, and that's how you do the question of master budget income statement. Hope it helps. Thanks for watching. Goodbye.